This is the Daily Fiscal Pulse for June 11, 2026. We're working with Thursday's settled data here, not real-time figures. Let's begin with what's happening in the broader landscape. The Iran and Middle East conflict is dominating headlines right now. There's talk of the Trump administration likely signing an Iran deal in the coming days, though certainty isn't at 100%. These headlines are clearly moving markets, but headlines tell only part of the story. The flows themselves give us the real picture. The net fiscal transfer for the session came in at $1.6 billion. That's steady on the surface. What matters more is the underlying momentum shift. The 5-day flow has dropped to roughly half of recent levels. Tax receipts are the main contributor here, posting $19.2 billion. The futures market is echoing the same message. ES closed at 73.94, sitting well below the 20-day moving average of 74.88. That 20-day range spans 385 points and is pointing downward, so flows and price action are aligned on this one. Taking a step back reveals the clearer trend line. Daily government spending on a 5-day average is running around $4.4 billion. The 20-day average sits closer to $14.5 billion. That's a meaningful deceleration. Less liquidity is flowing through the system, less cash filtering through households and into financial markets. Financial conditions are contracting as a result. Pull back further and the year-over-year comparison confirms it. Fiscal year-to-date spending stands at $1,138.9 billion, representing roughly a 5% increase versus the same stretch last year. That's still meaningful fiscal support in the system. From a positioning angle, the fiscal backdrop isn't offering a clear directional advantage right now. Our conditions gauge sits at -36, but we've seen this type of environment many times. Despite tighter liquidity, the S&P has historically averaged around plus 1.6% over the following month. Markets don't always move in lockstep with liquidity flows. They can, and often do, continue grinding higher. One positioning flag worth noting: margin debt is at the 100th percentile. That's historically elevated. Readings like that have typically functioned more as a caution than a confirmation signal. Here's how it ties together. With fiscal flows running below prior year levels, the system's shock absorbers are thinner. When news is favorable, markets find ways to edge higher. But when risk spikes, like a potential escalation in the Iran or Middle East situation, selling pressure can accelerate faster. There's simply less liquidity cushioning the moves. Several scheduled flows are on the calendar that could reshape the picture. June 15th marks the quarterly estimated tax deadline for the first quarter, which typically shifts short-term cash movements. The fiscal drag is clearly visible in the numbers, but the tightening pace may be stabilizing. The next meaningful shift likely hinges on how these scheduled flows actually land. That's our focus point.